Hello everybody, this is Logan and I hope you are doing well. This video is to summarize why in my opinion markets will likely not crash just yet. And a few important caveats here is that this is assuming no sort of unexpected black swan event occurs, such as what COVID was or what 9/11 was. And these sorts of events are just impossible to predict by nature, and also historically bubbles have not needed catalysts like these to begin deflating. It's a common narrative out there that there needs to be some sort of unexpected strong catalyst in order to pop bubbles once they reach their full level of inflation. But looking back at past bubbles, this has not been true. Rather, it is more so the surrounding instability of the markets which has historically led to the deflating of these past bubbles. And if history has anything to show us, it is that very little, if anything, changes from one time to another. Consider the crash of 1929, for example. I'm sure that none of you remember it, as you would need to be around 95 years old in order to have any memory of it whatsoever. But this was a very similar environment to the one we are in today. There was extremely high involvement with speculating in the stock market, higher than any point previously in history, with so many people throughout society speculating in the markets who previously had not. There were prior micro crashes in individual stocks and volatility spikes before the massive crash which occurred, and people at the top believed they had reached a new sort of paradigm of perpetual inflation of this bubble. So they did actually believe that this was not a bubble at all, but a permanent lasting bubble, and this proved to be wrong in a big way. And look at the dot-com bubble. This is much more recent history. During this bubble, there were also many commonalities with today. Again, massive speculation among retail investors, many micro bubbles and pump and dump schemes, and people believed these valuations were justified not based on fundamentals but on some new paradigm, and this also turned out to be false, and the tech stocks crashed massively, and the broader markets also were sunk collectively. And I could keep going with other examples of the housing bubble or the flash crash in 1987, but where I'm going is firstly, none of these bubbles required some sort of major unexpected world event to begin crashing. There was no new major outbreak of war or terrorism or natural disaster which caused these crashes to begin. So in other words, there was no catalyst. It was rather the preconditions of the market which eventually placed the market in and the central banks in such an unstable place that there was no avoiding the crash. And this is where I begin to differ from many of the other voices out there right now claiming that there is some sort of imminent market crash any day now. And in my opinion, it could be as soon as several months or a year from now, but several key factors would need to change in order for the market to get to such an unstable position, in my opinion. Firstly, investor sentiment would need to change. There would need to be very little, if any, liquidity waiting on the sidelines. Now, I am in no way advocating that you jump in completely right now, and in fact, none of the information in this video is advice, but there would need to be full confidence and irrational exuberance from the crowd of retail investors, or what is commonly referred to as dumb money, with regards to the broader stock market. And so far we have not seen this in the broader stock market. We've seen smaller pockets of irrational exuberance, and I'm sure we can all think of some right now. GameStop, Tesla, Dogecoin, Bitcoin, Hertz, all of these have been smaller pockets of irrational exuberance in the last year. But this same irrational exuberance and speculation would need to spread throughout the entire market, and it would also need to spread to other groups of people than just Robinhood traders. Institutional investors who were formerly skeptical would need to begin jumping in as they have prior to previous bubbles popping. And this would be the first major sign that the market is in fact in a very risky position and could crash soon, because historically looking back, this irrational exuberance and nearly complete acceptance of valuations has always occurred right before a major market crash. Secondly, because of the first reason I just stated of widespread irrational exuberance, broader market indices would need to be in an extremely overvalued state. And now they already are in an extremely overvalued state, don't get me wrong, but it is more so the rate of change that would need to be more extreme, the slope of these indices to be exact. So far, since the rally started in March of 2020, we have seen a nearly constant rate of cautious increase and then consolidation when the crowd of investors has raised some questions, and then more cautious increase at a nearly constant slope. But at the ends of these previous historical blow-off tops, the rate of changing prices has increased dramatically until, when you look at a chart back on a time frame of 10 or 20 years, the blow-off top and crash appear to be a nearly vertical line from that perspective. And this is where we also need to see change. We have not seen this rapidly accelerating rate of change from a constant horizontal line of increasing slope to a nearly vertical parabolic shaped line. Now this shift to complete irrational exuberance could come from several key factors that could cause this shift in sentiment from caution, right now of, will the Fed raise rates or will stocks sell off? It could shift to complete exuberance based on several factors. And these factors that could cause this shift from skepticism to exuberance, in my opinion, are fear of inflation, number one, and number two, confirmation in the bond market by rates heading lower. Now, inflation could cause many sitting on the sidelines to jump in simply due to them falling into the trap of thinking, we are at historical overvaluations, but since the Fed is going to let inflation run red hot and not do anything about it, I should simply just place my money somewhere so I don't lose purchasing power. And this is beginning to happen right now. Inflation and hyperinflation are really hot button terms right now. And most consumers are beginning to notice, this inflation in the prices of lumber or groceries or houses or healthcare, you name it. Now, the second reason for rising optimism could be that the bond market is beginning to indicate that rates are temporarily heading lower from their blow-off peak just several months ago. And in the mind of investors, this would mean that there isn't the risk of continually rising rates. Now, in my opinion, this is only a temporary correction in the bond market, probably only lasting a few more months, and it could very well be from the Fed manipulating the bond yield curve through yield curve control. But of course, long-term bonds are going higher. There is no doubt about that. But before the melt-up, the market is not looking long-term. They're really zoomed in, and you can definitely see how short-term focused investors are right now. And these are the reasons why I believe we are not yet likely to see a major market crash, but more likely to enter a period of extremely optimistic sentiment, ever quicker rising asset prices, and a nearly complete acceptance by the crowd that this is the new paradigm. It is when these factors come together that the market would be at extreme risk of correcting. But until then, it is less likely, in my opinion. It could still occur before then, as there is a lot of leverage in the system already, and if some unexpected event happens, that could trigger it. But, all things aside, when the markets reach the blow-off top, when there is no more money to come in and prop up prices, when rates begin rising again, either from market forces or from the Fed being forced to raise rates due to inflation, it is under these circumstances that the market would be poised for a major correction. Now, the crash itself is definitely the subject for another video, the mechanics behind the crash, but I do not think the Fed can simply print its way out of the current situation and inflate the markets in order to avoid this crash. I don't buy into this reinflation kind of a theory. As Warren Buffett has stated, if this kind of monetary policy worked indefinitely, it would have been discovered, 2,000 years ago. The Roman Empire would never have collapsed, in other words. But that being said, the mechanics of the crash are definitely the subject of a whole separate video. So if you liked this video, consider subscribing to this channel and hitting the like button. I call my channel The Contrarian because I typically come to a different conclusion than the majority of other investors. I do this not because I love going against them, but because I ignore the noise and emotions of the crowd, and also because the crowd historically has almost always been wrong. So that being said, I hope you enjoyed this video, and I hope to see you again.